Can uncorrelated assets truly enhance senior portfolio diversification? Imagine trying to balance on a boat during a storm. If all your cargo shifts together, you risk capsizing. But if some cargo stays steady, you might stay afloat longer. That's the idea behind uncorrelated assets in a retirement portfolio. Uncorrelated assets are investments whose prices don't move in sync with stocks and bonds. When stocks fall, these assets might stay stable or even rise. This can help reduce overall portfolio swings and protect your savings. For seniors, who often focus on preserving capital and steady income, this can be very helpful. Adding uncorrelated assets can make your portfolio less jumpy. When one part drops, the others can hold steady or recover faster. This means fewer big drops and a smoother ride through market ups and downs. During times of economic stress, uncorrelated assets may not decline as much as traditional investments, limiting losses. Common uncorrelated or low-correlated investments include high-quality government bonds, which tend to move independently of stocks. Gold is another example. It often acts as a safe haven when markets are shaky. Managed futures or trend-following strategies can perform well in different market conditions and are less tied to traditional assets. Some alternative investments, like hedge funds, aim to generate returns regardless of market direction, but they can be more complex and less liquid. It's important to remember that correlation can change during extreme events. For example, during the financial crisis of 2008, many assets that seemed uncorrelated started moving together as investors sold everything. So, uncorrelated doesn't mean risk-free. Plus, some uncorrelated assets are harder to access or understand. Alternatives might be less liquid, meaning it could take longer to get your money when you need it. Also, these assets often requiring ongoing management and rebalancing to keep the diversification benefits. If you don't monitor your portfolio regularly, you might lose the intended balance. For seniors, age-based asset allocation usually shifts towards safer investments like bonds and cash. But including uncorrelated assets can add an extra layer of protection. For example, a retirement portfolio might have high-quality bonds for income, some stocks for growth, gold for safety, and a small portion of managed futures to reduce volatility. This mix can help you stay steady through market swings, protecting your savings and income. Overall, uncorrelated assets can truly improve diversification when used wisely. They help lower risk and smooth out returns, especially when combined with a thoughtful, age-appropriate investment plan. Just remember to keep an eye on your investments and rebalance as needed to stay on track.